All right, the markets didn't respond too well to my 49th birthday here today. Obviously, had a lot more to do with prices rising at a faster clip than what people are very comfortable with, which we were pretty uncomfortable with on our vacation last week when we went to California for spring break. I don't think I've spent more money on food in a short amount of time than I did in this past week. But regardless, the market did not take too kindly. Had a little bit of a decline, but nothing too major. We'll take a look to see just how significant the move was in terms of producing the signals that suggest a new intermediate decline has begun, and then just how deep do we expect this intermediate decline to be. So we're going to break down the signals that we're seeing there and the big shifts. That three-headed monster that I always bring up, that's such a monster for risk appetite. It reared its ugly head again today, and so we'll break that down. Big move higher in yields and a reaction to the CPI report, all heading into another inflation report tomorrow on a wholesale level, and we'll see how much of an impact that has on risk appetite over the next day. So we'll break all that down. The big sector moves that we saw today as well, a kind of stealth safety trade, a couple safe haven areas that tend to do well when markets go south, did not today. But one area that lately has been doing well when the markets go south did in a bigger way. So we'll break that down, and then we'll take a look at our trade idea coming out of that home. The home builders really got hit pretty hard with these rising mortgage rates, right? Getting up well above 7.25%. And so that impacted them pretty negatively, and that's where our trade idea is going to be on the day. So let's go ahead and get started. Today is Wednesday, April the 10th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I review all the trades that we've done in prior Market Outlooks. We actually closed out a trade today that we had opened in the prior video. And then obviously we put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab, and hit that like button there. Same thing here, click that thumbs up icon. It opens up this tab, and hit that like button. Again, the more you do that, it helps get our content out on those platforms. That's how those algorithms work. It's a big deal to us. That's why we always ask. So thank you to those that do this day in and day out. Our goal is always to get to 100 likes on Twitter. So thank you again for those who like it. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, we got a bull tag today officially for the first time on the S&P 500. Which means, again, we got a light pink shading and a yellow line. So what the light pink shading means is that the intermediate line is falling below the 80th percentile, but still above the 50th. So once it crosses the 50th, then your dark pink shading over here. And then the yellow line comes from being below a rising moving average or above a falling moving average, like over here. But of course, in this case, you're above a rising moving average. So you get that combination, and it tends to be either a signal that we're going to start a new intermediate decline, or we're going to bounce back up and start a new leg higher. And like I said before, you get above the high point of the day, you get the bull tag, and there's a good sign. Now, granted, keep in mind that we had our first bull tag over here, and technically you don't see it because we didn't have light pink shading on the day. You had dark green shading, but the principle's there, and other indexes got it, so the principle's there. And essentially that high point it remains the kind of the clearance that we need in order to start a new leg higher. Considering how mature the actual run is, it's one thing to get a new leg higher when you're only a month or so into the trend. It's another thing to get a new leg higher when you're 4+ months into this trend. We started back in the beginning of November, and we're now past the beginning of April. So that's what... 4 months, 4+ months there. So pretty long trend, very mature trend. Typically these intermediate rallies typically last 1 to 3 months. So the fact that we are 4 months in kind of is saying something in terms of how strong this move is. Your intermediate line is still in bullish territory, so it hasn't really fallen out, hasn't gotten below the chart's midpoint yet. That's where that's like I said, where you get the dark pink shading up there. It hasn't fallen into bearish territory, so we are still not in a bearish decline. Like, we can still just bounce off of this and keep going higher. It's unlikely we will, but we could, right? That's the scenario, especially with the market sentiment line as high as it is. And again, it's one thing when you're in the market sentiment lines are just barely getting in the reversal zone, or is not even in the reversal zone, and you get these bull tags. But when you're in the reversal zone and have been for multiple months, again, it's another sign of maturity of the trend. And again, the likelihood that this bull tag may be the start of a decline, right? Now you notice when you get them, it doesn't immediately start the decline. I mean, there's some up and downs, but eventually it leads to dark pink shading and a red line, which we already do see on the Dow Jones Industrial Average, right? The Dow Jones has the dark pink shading and a red line there. It has not broken the 23% retracement yet, which is kind of another indication that an intermediate decline has begun. But you can see that its intermediate lines, not only like you got dark pink shading and a red line, you're not only below the chart's midpoint, but you're in bearish territory, and you're that close, probably another day away from getting into the lower reversal zone. So that's a pretty strong bearish intermediate trend to get that intermediate line already down there. Again, what will get it back out is getting those short-term sentiment lines up above it first, which, again, we have that, or to get them into the upper reversal zone. And obviously we're nowhere clear. I mean, that's a pretty bearish peak for the near-term line, just to barely get above 50 and already turn back down below it. Now it's, just a little drop, so we'll see if we build on this tomorrow or not with the PPI. You are 1.5% below the moving average, which again, the furthest below that we've seen, any of this period. You are a little bit below it on these bull tag days. But we are clearly far more below it now than we were then. Your NASDAQ 100, and your Russell kind of looks similar in a couple of regards. In one regard at least, the intermediate line has fallen below 50. So you got the dark pink shading up there. You don't have a bull tag. Even though you got a yellow line, you don't have a bull tag today because you have dark pink shading instead of light pink shading. So the intermediate line has now fallen enough to where it's into the lower half of the chart. Again, you have this bull tag over here. This bull tag, you got above the high of that day the next day, right? But this bull tag, you can see we haven't come close to getting above the high of that day. In fact, we're getting closer to dropping, below the low of that day and continuing to decline there. So, man, that's the NASDAQ 100. That's been the big leader of the markets here. The Russell 2000 really struggled today. It was the biggest loser by far. It fell 2.5%. So you remember the S&P hasn't fallen 2% for who knows how long. And your Russell just did it today. So big drop. The intermediate line also into the lower half of the chart, so crossing the 50th percentile. But it doesn't have a yellow line. It has a red line. So the momentum, the moving average up there at the top is already turning lower. And remember, this is the bull tag that we're trying to get up above. And we see this bull tag, you started below it, but you finished above that low and then got above the high point the next day. Here we still have not been able to get above that high point. It's hard when you have such a big range that you have to clear, and we just haven't been able to. You look at the weekly chart for the S&P, again, very, very small candle. The PPO is rolling over, but still above the 90th percentile. So, and you've got a negative candle, but it's not very big. So you're still pretty strongly, you're very weakly bearish there. Nothing significant at all. That's not the case on the Dow. You can see that candle's a pretty decent sized candle, and you're below the 10-week moving average. It's coming off of a bearish candle that we had, bearish transition candle last week. And the PPO is clearly moving a lot lower now. So things are looking a lot worse for the Dow Jones Industrial Average. And that's been kind of a common theme lately of the different videos we've been doing. We had a green arrow yesterday on the S&P. We're back to 3 reds. So there's, again, 1 or 2 days is okay. Again, can we get back up above these highs and clear this? The Qs have had now 3 red arrows for 4 of the past 5 days. The Dow has had 3 red arrows all 5 of the last 5 days. This is all going back to that last Thursday when everything had 3 red arrows, right? When we really broke down hard. So we had the Dow has been down, had a red arrow all 5 days, and then your IWM has had 3 red arrows 3 of those 5 days. But you can see all the indexes showing 3 red arrows again. So the stochastics dropped on the IWM, the MACD dropped on all these indexes, and then back below moving average on all of them, with the Qs and the S&P kind of giving us those quasi bear tag signals here, bull tag, signals here today. Looking at the 2-line version of this chart, we're back below the 30-day moving average, which is not very common. The MACD is still falling below its moving average, and we're not very far. We're still above the 50 at least. Now, the MACD has not crossed below 0. The stochastic still is not crossing the bearish territory, but you see that we're kind of on the cusp of that happening, which, on this chart, that would signify an intermediate decline, which you do see on the Dow, right? The Dow, the momentum line did clearly fall below 0. Now, in fact, the average is about to fall below 0, and the stochastics and its average are both in bearish territory, and we have clearly broken the 30. The 8 and the 17-day have broken the 30, and we are below the 50. And you have this gap to fill in between. Now, you do have some very, that's this high point, this 0% Fibonacci level goes back to the early January 22 peak that we had broken up above at the very end of the year. The peak before the 2022 correction. So this is the move we've had since that peak. So there's, that happens to be also the 38% retracement of this current intermediate rally that we're on. So there's going to be some pretty decent Fibonacci support right there, as well as the top of the value area and a pretty decent sized volume node right around 375. So keep that in mind in terms of, as we expect the gap to fill. It doesn't always feel like in a straight line, right? Sometimes there might be some stops for because there's some support in this area from other places besides a moving average. In this case, from the volume as well as from these Fibonacci levels. That's your diamonds, your IWM. You can see also broke clearly the 50-day moving average today. The MACD and stochastics getting themselves down the bearish levels with a jump in volume, right? 1.5 times the average volume down there. When you look at the some of these other oscillators, so the S&P, your negative indicator is almost above 30, not quite. It has been above 30 for a day. And it's sitting right around there now, but for the first day, the positive indicator has fallen below 20. Hasn't been below 20 since we rallied off of that low point here after Halloween low point. So that's a pretty significant change for the S&P on this chart. Again, that signifies intermediate decline. The Dow does have that combination of being above 30 and below 20 on those two lines. Your IWM, remember, made such a big move today. You did at least get a positive crossover there, or excuse me, a negative crossover with the negative line crossing above the positive, though the positive has not dropped below 20 yet, with the negative being up above 25. If you look at the RSI and the CCI, you are back below 50 on the RSI, and you are below minus 150 on the CCI. So the first time the S&P has shown a pretty bearish pattern on the CCI. Now, again, it's still going to be green shading here until the weekly version of this indicator falls below minus 100. Obviously, we're nowhere near that. So when you're in the green shading and you get a drop below minus 100, that usually can be pretty bullish unless it drops below minus 150. And that's when you are now a little bit more concerned about the beginning stages of an intermediate decline, kind of like this move over here, where you drop below 150, you have the beginning stage of intermediate decline. The RSI eventually worked its way below 50 on that same day, and then eventually confirmed it by dropping below 40. So that's why it turned red. But the CCI, you can see the weekly CCI stayed above for quite a while before it turned down. But that was the beginning stages, and that's similar to the pattern that we're seeing right now. Remember, the Dow Jones Industrial Average still hasn't dropped below minus 150 or 40 on the RSI. So as bearish as it's been, it hasn't shown those patterns yet on those lines. The stochastics, this is an interesting pattern. Oh, we'll come back to this one here in just a minute. Let's look at the Ichimoku cloud first. Still have a strong trend. We haven't broken the trend yet. We still have a positive rate of change, though it's very small. and you're still up above the cloud, though you are slightly below that blue line there. The diamonds has lost its trend and is now inside the cloud. IWM obviously has lost whatever trend it's had and is now flirting with the cloud with a very strongly negative rate of change. The Qs have lost its trend and is below the blue line and flirting with the cloud with a negative rate of change. So things are turning south on these indicators as well. Looking at the Bollinger Band and the Keltner channel, you can see that the bandwidth's still really small. We haven't broken out. We're still haven't even gotten into the lowest quartile yet on the S&P 500, and that bandwidth is just really, really small inside the Keltner channels there. But keep in mind, the diamonds, we are in the lowest quartile. We do have the bands outside of the Keltner channels, and we are pushing against that lower band. So a lot more with a increasing bandwidth. So you can see how, again, the Dow is kind of taking the lead in terms of a change in direction for this particular, for the current risk appetite environment that we've been seeing. If you take a look here at the intraday chart, we did gap down, though we did not run away from the open. We actually started to fill in some of that move up here to the upside before falling back down, and then end up closing around yesterday's low point there. So still kind of right around the point of control, and again, no new low point. The high is below 70. Got a very small range. So again, we're due for a move that we actually got on the diamonds. So the diamonds, we did get a jump to 100 now. So you got a new 4-week low point today. We gapped down. We rallied up to yesterday's low and last week's low and held it and stayed below it the entire day. Even if we didn't necessarily run away yet, we did form that new 4-week 4-week low point, and now have started to expand this really small channel, 4-week price channel. As I mentioned, we were kind of building up to a squeeze play, and you see that here. Like, look at the ATR moving up and working its way back above 1 potentially. Look at the volume has been working up for so long. So things are starting to pick up here. What really hasn't picked up, and what's actually a pretty relatively positive sign, is the VIX hasn't picked up. It actually kind of fell down at the close, ended up down at 1562. Nowhere near getting above 95% yet. Even with the VVIX up above 90, we really haven't had an explosion on volatility index yet. It is above the 200-day moving average, which on that chart is a sign that we are in intermediate decline. You can see that stochastics is higher than what we've seen. And we've held the 200-day, for that matter, held the 8-day as well. We spend a lot more time up above the 200-day than we had previously, when we've come right back below it every time we've gotten above that. So again, another indication that the sentiment's a little bit more bearish this go around than any of these other little instances that we've had over the past few expiration cycles. All right, now let's take a look at what's driving this price action here. So let me bring up the asset class comparison chart. You can see the move, but you can see that big drop in bonds. Of course, the CPI was the big mover today. Here, let's change the date just to today. And you can see the impact that it had on risk appetite in general. The dollar was up, commodities were up, yields were up. There's your three-headed monster, right? That's the three-headed monster we talked about. Has a negative impact on risk appetite, really weighed down on small caps this time. Sometimes it weighs on the Qs more, sometimes it weighs on small caps more. And today, the Russell got hit pretty hard. Real estate also dropping as mortgage rates getting up to strong levels, and just rising rates in general really hurting that particular sector. 4% decline in that area. But if you look at some of these charts here, let's look at the for some odd reason the 10-year yield's not working on our Think or Swim charts. But if I look at it over here, you can see we jumped up to 4.55% today, down a couple basis points since the close. That's a good move. That's a really, you can see yields have really started to pick up in the past week or so. Let's get this to 3 months. There we go. That's a big move higher there. And it's not just the 10-year, right? The 2-year has also really made a jump higher up to 20 basis points today. So you think, oh, the yield spread actually went down, which is kind of interesting, but it kind of goes to show that, we're still not really normalizing that. The yield curve typically normalizes before the Fed starts cutting rates. So the fact that it still hasn't gotten back above 0%, kind of, again, it goes to explain one of the reasons why we're just not getting, like, the odds of a rate cut are just minimal. If you look at, the meeting we have coming up right now, the odds of a rate cut are 5%, 6% odds of a rate cut, which, a month ago was at 23%. Now it's at 6%. But if you look, just a couple of months ago, just back here, let me get the historical chart up here. I don't know why it's acting so slow on me. Okay, so just a couple of months ago, back on February the 1st, the odds of a rate cut were 94% of just one. Now, the odds of 2 cuts by this upcoming meeting was 83% on 3 months ago. So even though we lost that one by February the 1st, at least we still had a very high probability we get at least 1 cut at this upcoming meeting. But you can see both of these lines moved up 100, which means that we have a close to 100% odds that we won't get a rate cut in May. That's in just a couple of months. Those odds have just evaporated as yields have taken up. Now the 3-month yield has not moved. Remember, the 3-month yield is the effective Fed funds rate and kind of prices in whether or not the when they will cut or when they will hike. It's been this way since their last hike, right? Their last hike was back here on July 26th. The 3-month had rallied up, anticipating that one more hike, and it's been now there, plus or minus a few points, but it's been right around there this entire time. Remember, the range is 5.25, which is way down, obviously way down here. 5.25 is down, in this area at the midpoint, or right there, right at that line, and then 5.5 is up there. So we've been in the middle of that range, towards the top of that range, pretty much the entire time since the last rate hike in July of 2023. So the market just is not pricing that in as much as the Fed Fund futures were. The bond market hasn't been. And now you can see these rates are jumping back up because of that. Now, the one good sign is the last time we made a run up to 4.5%, it really put a lot of pressure on equities. So we were in a clear intermediate decline last September, coming off that late July peak, going through August and September and October. We're not clearly in a decline yet. If anything, we may be starting one, but we were well into it by the last time we got to 4.5%. So the fact that the stock market is actually holding up as well as it is, even though we've been pretty much rising since the beginning of the year on yields, have gone from well below 4% up to 4.5%. At least it's a good sign that the market is not necessarily as beholden, is not as sensitive to these big jumps in yields quite yet. Again, other parts of the market are like the Russell 2000, which because of that, we ended up with some really bad breadth today. You can see the McClellan oscillator dropped below 35 for the first time since back over here at the very beginning of February. We had a day where we dropped below 45. Back over here at the beginning, right before January expiration, we had a few days of some bad breadth. But your McClellan summation index is still easily above 500, so it hasn't broken that level yet. But one of our first days of bad breadth that we've seen, if you look at the money flow indicator, which is that normalized volume level, kind of a cumulative volume level, we have easily broken down on the oscillator now. We did at the beginning of the year too, but now we'll see if we break below 40 or not, and really start this decline. Remember, on the long-term basis, this index is so extremely high, so nowhere even near a move lower yet. But it starts in the daily chart, at least getting in the bearish territory, as you can see. What the summation index or flow index did over here. We're kind of like we're working in that direction. If you look at some of the other breadth indicators that we look at, You see that here. Let's look at the new highs and new lows. So let's pull this up here. Our first time being negative in quite some time, so well below the moving average. But now, again, since the beginning of the year was the last time we've been pretty clearly negative on this particular index. So when you look at the number of stocks above the 50-day moving average, big time drop. One of our biggest drops, again, that we've seen since over here when we had been below it for quite some time. This is a big one to kind of start a move to the downside because we had just barely crossed below. And the same thing when you look at the number of stocks above the 200-day, it's a pretty significant drop for that particular index too, relatively speaking. Again, both below their moving averages. Big jump higher on the ratio, and again, that typically coincides with a move lower, at least the beginning stages of a move lower. So even the breadth signs are showing that things are starting to look a little bleak. Again, I don't think we'll necessarily have a big decline. As you can see, the bullish percent index is well below 70, with the average actually above 70. Well below 70 there will also put some pressure from a breadth standpoint on risk appetite. The one thing that has been the one thing that did okay today, with the Russell doing as bad as it was, you actually had some of these mega cap names did okay, especially Nvidia. Nvidia was up 2%. We got that bull tag. We still haven't closed above the high of that bull tag yet, but at least that bounce back up helped stave off probably more of a decline in the Qs. Probably would have been a lot closer to what we saw in IWM had it not been for that jump in Nvidia, because you can see Microsoft and Apple were both down. Amazon was flat. Google was relatively flat. Meta was actually up. Broadcom, Tesla was down big, but Tesla has been down big. AMD continues to be lower, unable to get above that last Thursday's high point. Cisco and Netflix kind of flat. Broadcom kind of flat. So at least we're not like clearly bearish across all these kind of main leaders for the market right now. These some of these significant mega cap names. And if I were to take a look at the sector comparison and just look at today alone, you can see energy and staples doing better, which you would expect in a day off like this. Interestingly enough, utilities and real estate were the biggest losers. You wouldn't expect that. They're not the biggest risk-on asset classes or sectors, but they are very interest rate sensitive. So a big jump in interest rates put a lot of pressure in those areas. But really right now, outside of utility, because of rates rising, utilities and real estate end up not being the same safe haven as they normally are. It ends up being energy. Energy tends to, because of the inflationary environment, tends to outperform. And that continues to be the case. It's been so parabolic here. Energy has been so parabolic. And you can see it's still, was up again today. It's well above its 50. This ratio chart, is well above its 50-day moving average. And the relative strength is very strongly bullish. That's one of the only sectors that's clearly in the leading category. But utilities is up there too. Materials and industrials and financials are also in that leading category. You have real estate, healthcare, and technology and discretionary over there on the left. So a weird rotation going on, but no clear leadership, no bearishness yet either. And I think we'll probably avoid it thanks to how strong some of these areas are, these dollar sensitive areas, as well as like even communication services, which has been holding up pretty well despite the changing sentiment here. But as long as we kind of get this kind of wishy-washy rotation, then we might be able to avoid more of a major decline. I've told you before that the S&P has produced a record here of 27.5% run without a 2% decline. The last 2% decline before this one here was late last summer, early fall, when we had those three different moves there, boom, boom, boom. Well, we did get a 2% decline, and the last time that we had such a big move like this in the mid-90s, where we ran up, I think it was 26%, which was the record, and now it's 27%. We only had like a 2.09% decline after that one before we rallied up another 7%. So because we're so strongly bullish, it's hard to fight that. So it's more than likely this is probably there's going to be a very, very weak pullback here. Enough to actually be a pullback to bring the intermediate line down and other things, but not enough to actually like start a more significant decline that leads up to more like a 7% or 8% gain, or maybe even up to correction levels, again, like we saw back over here where we ultimately fell about 10% combined during that particular pullback. All right, that brings us to our trade idea of the day. And I want to take a look at Home Depot. Home Depot is in this kind of home builders area, kind of the supplier of a lot of, especially the do-at-home type stuff. Has been on a pretty bearish decline, has already got an oversold cluster. Just produced a bearish near-term peak. The market sentiment line's falling, your intermediate line still falling in the reversal zone. You are in the below the ninth percentile of the 52-week range of this, of how far away we are from the moving average. So pretty significant move to the downside for Home Depot. You can see its weekly chart. Hakinyashi candles look very, very bearish. Pretty decent sized candle there. Again, the size of candle that typically is either ends an intermediate decline or begins one, since we're just barely starting one. And so you lean towards that direction there. Obviously, you have 3 red arrows on the stock. We have dropped below its recent lows and kind of bounced off that 8-day moving average and trying to make a run into the rest of this gap, right, between the 50 and the 200-day moving averages, and actually into the value area where it can be more sensitive to the point of control down there. If you take a look at some of these other oscillators, you can see a bearish pattern on the DMI above 30, almost below 20, but not quite on the DMI. Look at the RSI and the CCI, and you can see we already had broken below minus 150 on the CCI. We're now clearly below 40 on the RSI. So bearish patterns on both of those particular charts. The Ichimoku cloud, we are below the cloud, very strong negative rate of change below the cloud, and starting a new weak bearish trend right now. And then finally looking at the Bollinger Bands here and the Keltner channel, and you can see we are very significantly rising Bollinger Bandwidth, and we are in the lowest quartile, and we've got some strong bearish momentum with the stock closing today outside that lower Bollinger Band for the 4th time in the past 7 trading sessions we've closed below that lower band. So definitely trending to the downside. The question is, again, we're kind of coming up pretty close on some of these levels. So what I decided to do here is, instead of doing a short term or a long put vertical spread where I have to hold on to it all the way to May expiration, I decided to do a bear call spread here and see if I can get most of that gain pretty quickly, since calls lose their value so much. So I sold what at the time was a low 30s delta, or mid 30s delta, excuse me. Now it's closer to 40. I think it was 38 when I got it. Sold the 360, bought the 365. Gives us this trade, gives us that break-even level right there, and that break-even is this blue line. Basically, we'd have to reverse this gap down and get back above those moving averages for us to now be able to take what we'd be willing to, which would be a $510 loss, since that's the credit that we're trying to achieve, the maximum gain, excuse me, that we're trying to achieve with the credit that we get from selling this vertical spread. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.